Is the 4% rule too conservative or too risky? Let's find out. With all the global tensions between trade conflicts and geopolitical conflicts, it can be nerve-wracking thinking, will my portfolio survive? Am I withdrawing too much? Will the next downturn completely wipe me out? So to check the numbers myself, I pulled the data for the S&P 500 going from 2026 all the way to 1927, nearly 100 years worth of data, and see, are we actually living in a period of higher volatility? In this graph, you can see in blue monthly percent change in the S&P 500, and orange the total share price. Now, obviously, the time of the 1920s to 1930s had significantly higher fluctuation and volatility due to the Great Depression. However, more recently, it's hard to tell whether we are currently living a higher period of volatility compared to the other data points. So I want to run standard deviation, which is a calculation used to determine volatility in stock market prices. When graphing out the standard deviation by decade, you can see that we are currently at the highest volatility going all the way back to the 1930s. The 1930s were significantly higher volatility with a standard deviation of 10.9% compared to our current standard deviation of 4.95% for the 2020s. So when analyzing the 4% rule, I think it's safe to say that the volatility that we're seeing is relatively close to the volatility that was seen in the 2000s, 1980s, 1970s, and 1940s. This will be helpful when we the statistics on whether a 4% withdrawal rate survived those time periods. Now that we've reviewed stock market volatility, I want to get a better understanding of what the 4% rule is and where did it come from. The 4% rule was developed by William Bengen in 1994. He analyzed data between 1926 and 1976. What he focused on was based on a few key assumptions: that your portfolio contained a 50% US stock allocation and a 50% intermediate bond allocation. You would be withdrawing money from this portfolio for a maximum of 30 years, so a very traditional retirement, and that you would adjust your withdrawals only for inflation year after year. So for example, say you had a portfolio valued at $500,000. You would do a 4% withdrawal on that first year. So 4% of $500,000 would be $20,000 annually. Every year thereafter, you would adjust for inflation. Say in year 2, there is a 2% inflation over that first year. So you would adjust your withdrawals by increasing that $20,000 initial 4% withdrawal by 2%, would be a $400 increase. So in year 2, you'd withdraw $20,400. And say in year 3, there is a 3% inflation. You would then take that $20,400 and increase it by 3%, which would come out to $21,012 in year 3, and so on. You would follow this method every year for your 30 years. Now, what the study analyzed was what's known as a sequence of return risk. This is very critical. It can drastically change the outcome of your retirement. So say in year 1, there is a market correction or a recession. In that first month, if the market tanked 20%, that would have a huge impact on your future growth because you'd be withdrawing those assets at depressed prices. Now, the sequence of return risk is most crucial in the beginning stages of retirement. So if you retire and the economy is in the growth stage of its business cycle, you're selling funds as they continue to appreciate. Going into years 2, 3, 4, 5, your balance is actually increasing because you're only withdrawing 4%. Those investments could be growing by up to 18 or 20%. It's not uncommon for the stock market to return 20% within a year. So when your funds are growing in the beginning, it's very likely that towards the end of your retirement, you will have plenty of money to continue to withdraw. The biggest risk to sequence of returns is having the first 2 to 3 years, say there's a bear market or a global recession, and those stocks take several years to recover. So with that being said, is the 4% rule too safe or too risky? Well, 3 finance professors from Trinity University did a more in-depth study. In their analysis, they ran numbers for every 30-year period between 1926 and 1995. In addition to the larger data set, they also analyzed varying percentages of stocks versus bonds. They measured 100% stocks, 75% stocks, 50% stocks, 25% stocks. They concluded that the highest chance of success in any 30-year period, a 50% stocks up to 75% stock. And in addition, going out further for longer time horizons, a 100% stock portfolio was more likely to succeed in longer duration due to the higher return. Now, another interesting fact, with a 3% initial withdrawal, every portfolio had a 100% chance of success. So in today's market with a lot of volatility, I think having anywhere between a 3 and 3.5% withdrawal is incredibly safe. In actuality, with 50 to 75% stocks, you're very likely to actually end up with a larger portfolio balance than when you started after 30 years of withdrawals. So where does this leave us? Well, I've actually found it very helpful to use an online calculator and play with the numbers myself. This calculator that I use is very unique in that you can adjust your bond, stock, and cash allocations. You can pick whether you want it to be inflation adjusted or not. You can input your initial portfolio size and what your first year withdrawal would like to be. Then you can see historically what years would have resulted in you not having enough money at the end of the year, and what years your portfolio balance would be a little less than what you started with, and what years your portfolio balance would actually be greater than what you started with. I think that's very helpful for doing your own risk assessment and determining what a safe withdrawal rate is for your risk tolerance. Because finance is very personal. Everyone has a different risk tolerance that they're willing to accept, which allows for varying levels of withdrawals and stock and bond allocation. If you'd like to use this calculator, I've left the link in the description below. If you found this video helpful, please like and subscribe. If there are any other topics you'd like me to cover, please leave a comment below.